So in this video, we are going to discuss about the advanced topics in NPV. So we'll be discussing about inflation, real and nominal interest rates. We'll be discussing about how to compute NPV when there's a nominal cash flow is given or real cash flow is given. We'll also be discussing about tax, tax allowable depreciation and working capital in NPV. So we'll start from the NPV and inflation. So real cash flow is an uninflated cash flow. It states the value of cash flow that is going to be received in future but in today's terms. Okay. So the cash flow that we are going to receive in the future, that is being stated, but it is stated in the today's terms. Okay. Real cash flow also called as cash flow at today's value or the current value cash flow. Okay. So that's how it's named as. The other one is called as the nominal cash flow, which is an inflated cash flow. It states the value of cash flow that is going to be received in future terms. Okay. So assume that you are going to receive 100 rupees. That 100 rupees is not in today's terms, but in the future inflated cash flow terms. So nominal cash flows are also called as money cash flow or inflated cash flow. So what is the relationship between the real and nominal? See, the relationship between the real and nominal discount factor can be brought like this. So we have this formula 1 plus I equals to 1 plus R into 1 plus H. So the I refers to nominal rate, R refers to the real rate and H refers to the inflation. So the nominal is equal to the real into the inflation. So that's how the formula works. So the relationship between the real cash flow and the nominal cash flow, real cash flow and nominal cash flow is like this. So nominal cash flow is equal to the real cash flow plus add the inflation. Okay. So how do you work out a problem if it's given in the exam? We have to check how many rates of inflation are there in the problem. If there's only one inflation rate, then this is the sequence in which you have to solve the problem. So if real cash flow is given and the real discount factor is given, it's very simple. You normally compute the NPV. If nominal cash flow is given and the nominal discount factor is given, you can directly compute the NPV. So whichever method you use, the NPV will be the same. You will get the same NPV. Assume if it's going to be given in a mix and match, for example, real cash flow is given but nominal discount factor is given. Okay, then you have to convert them in an equal basis. So either you have to find out the real cash flow and the real discount factor, or nominal cash flow and nominal discount factor. So what we'll do is we'll try to inflate the real cash flow and get nominal cash flow. So now what happens is we have nominal cash flow and the nominal discount factor. We can now compute the NPV. Or okay, as a or, you know what is the real cash flow. What you have to do is you have to only get a real discount factor. So try to get a real discount factor by using this formula. Okay, so now you will have the real cash flow, you will have the real discount factor. Now you can compute the NPV. What would happen if they give you a nominal cash flow and a real discount factor? See, then what you do is try to find out the nominal discount factor. Okay, you can find the nominal discount factor through this formula. So now what happens is you have the nominal cash flow and the nominal discount factor. You can now compute the NPV. This is how the approach works. Okay, ensure you understand this approach because from an exam point of view, this is a very important question. So this is how you are going to find out the discount factor. So whether you are given a real discount factor or the nominal discount factor, you can interchangeably you can find out the other number. So the formula is 1 plus I equals to 1 plus R into 1 plus H. We'll assume for this problem's sake that nominal rate is 20%, real rate we don't know, inflation is 10%. So once you have applied in this formula, finally we got an answer that the real rate is 9.1%. So how can we apply this in a numerical question? In a numerical question, assume that they have given you the real cash flow. So these are the real cash flow, and just now in the earlier problem we have computed that the real discount factor is 9.1%. We have got real cash flow and we have got real discount factor, so we'll discount these things. We have got the present value and we have also got the NPV. So our NPV is 2103. Now what we'll do is we'll apply the same logic for nominal. So the real cash flow is the same as the earlier problem. So in the earlier problem also we got the same real cash flow. So we have not changed this number, it's the same number. Inflation is 10%. So here inflation was 10% and nominal rate was 20%. So we will take inflation, we'll inflate all the numbers. So for 0th year we can have 1 as inflation. For first year it is 1.1. For second year it's 1.1 into 1.1. For the third year it is 1.1.1 into 1.1. So it's like cumulatively it gets added, it's like compounded. So that is the inflation here. So what happens is we have got the nominal cash flow. Okay, now the nominal discount factor is 20%. We will get the discounted rate. So what happens is the answer which you get here will be the same as the answer which you got in the earlier problem also. How come the answer can be same? Because we have inflated it by the same 10%. Okay, and the nominal discount factor which we used in that formula was 20%. So if you are going to have the same parity, you will get the same answer here. So whether you use the real cash flow and real discount factor or nominal cash flow and nominal discount factor, you will arrive at the same answer only. See, this works only when there is a single inflation rate. If there are like multiple inflation rates, then what you should do? If real cash flow and nominal discount factor are given, then inflate all the real cash flow with the several inflation rates that are given. So you will arrive with the nominal cash flow. As you already have the nominal discount factor, now you have the nominal cash flow. You can now compute the NPV. So you can so once you have several inflation rates, this is the only way in which you can solve the problem, and this is a very important from the exam point of view. So again we'll tell an example. If sales inflation is at 10%, if variable inflation is at 5%, if fixed cost inflation is 15%, then there's no other way. You have to get nominal cash flow, you have to get nominal discount factor, then only you can get the NPV, right? So here we look at the NPV and tax benefit. So as you have a machinery or something, you will be like having depreciation, and for that depreciation you get some kind of a tax benefit. So first you have to compute the depreciation. So then for the depreciation, if you multiply the tax rate, you will get the tax benefit. Okay, so that's how it works. So here we look at the NPV and working capital. So for working capital there are like two parts. Okay, if the working capital is going to be released and if the working capital is not going to be released. So first we look at the working capital is going to be released. Okay, so when does the working capital gets released? When the project is going to be ended, okay, and the machinery is not going to be replaced or the project is not going to be continued in the future, then the working capital is going to be released. So you have to work out a table like this. Every time or every year you invest your working capital, but in the last year as the working capital is not required, it is released. So these are like cash flows which are going out of your company, but in the last year the cash becomes a inflow. This happens only when the working capital is going to be released and the machine is not going to be replaced. Only in that situation this applies. So what would happen if the working capital is not going to be released and it's going to be just keep continuing with another machine or with another factory? what would happen in that case? In that case, even in the last year, the working capital is just invested. So there's no release of working capital and there's no cash inflow. The last year is also a cash outflow. So how do we compute the working capital? See, working capital can be computed as a opening number. Then we can add the percentage of working capital required. We'll arrive at the closing. The closing becomes the opening. Again, we add the inflation or the working capital required. We arrive again at the closing. So it's a iterative step which keeps on like continuing. So which of these numbers go to the NPV table? So this number, the additional working capital required alone, goes to the NPV table. So here we look at the NPV layout for a lengthy problem. So this is the NPV table for a lengthy problem. Usually you have to start with the sales, deduct the variable cost, you will arrive at contribution, then deduct fixed cost, you will arrive at profit, then deduct the tax on profit, add any tax benefit, depreciation if you have. You will arrive at the cash flow from operation, deduct the capital expenditure, add any scrap value if there is any. Usually it will occur in the last year. If there is any cash outflow of working capital, show it as a minus number. If there's a cash inflow, show it as a plus number. So you arrive at the cash flow now, add all of them together, you arrive at the cash flow, use the discount factor, get the discounted cash flow, you will arrive at the NPV. So this is about the NPV format for a lengthy problem. So we'll have a quiz. When computing the cash flows for a capital project, which of the following is least likely to be included? Which of the following is not to be included? Tax effect we include because we have the depreciation. So we include this. Okay, we include this. Financing cost is not included because discount factor is the financing cost. So this is not included. Opportunity cost we have to include because it's a part of the relevant cash flow. So usually we take this into account. So what is not taken into the cash flow of a project is the financing cost. So B is the answer. So there are like questions which have appeared in the past exam from this topic. So they have asked you discuss the difference between a nominal approach and a real approach to calculating NPV, and it's a 5-mark question. Only once it has appeared in June 2013 question paper, but this can come in 2 marks. So ensure that you have understood the approach clearly. So thank you very much for watching this video. We'll meet in the next video.